Oil remains an incredibly popular market with investors and traders around the world, but with West Texas Intermediate, Brent crude, futures or cash, there are a few different options. Is there a right way of doing it? Hello, I'm David Jones from Capital.com. I thought we'd do a quick video looking at the nuts and bolts of oil. Should you be trading Brent or West Texas, cash or futures markets, and what drives the oil market. So in this video, we'll jump on in a second and take a look at the three different markets we offer for oil. I'll come back, talk about the ins and outs and explain it all in a lot more detail. As usual, if you're watching this, if you can click on subscribe, support the channel, and we'll continue to push out, hopefully, interesting videos like this. So if I put oil into our trading platform up here into the search, so these are the markets I get. So crude oil, this is West Texas cash price trading at what, 18.68 at the moment. Brent oil, so this is the cash price for Brent trading above $25. So more than $6 more expensive than crude, US crude. And then down here we have Brent crude oil futures trading at $25.25. So I'll talk a bit more about the differences between these markets and perhaps which ones we should be picking if we'd like to do a trade. So we'll come to the different types of oil in a minute, but let's talk about the contracts. Should you be trading the spot price or the futures price? So the spot price is the cash price. So if you drove up to an oil producer's gates and said, I want to buy a barrel of oil now, the spot price, the cash price, is what you pay. So that's the price for immediate delivery. Then we have various futures contracts, let's say June, September, December 2022. And these are for delivery for oil at some point in the future. Usually the futures contract trades at a premium to the cash price. There are extra costs built in, the so-called cost to carry, any cost of storage, financing, all of that. So we'll see the futures contracts normally trade slightly higher than the cash. Oil futures trading on exchange for a specified amount of oil. It's 1,000 barrels, for example, when it comes to West Texas Intermediate. If you trade the futures with us, you can specify your level of risk for the trade. And in the futures markets, in reality, when it comes to traders, few of these contracts get delivered against. Somebody trading the price of Brent June, for example, has little interest in either taking delivery of oil or supplying that oil to somebody else. So traders tend to exit the contract and then roll over into the next month if they want to keep the position running. They're using the contracts to speculate on the price direction of oil. So which one should you be using? Well, if you look at what our clients are doing and what clients have done over the years, typically for shorter term movements, we see clients using the cash price. It has, usually a slightly tighter spread than the futures markets, although futures market spreads are pretty tight anyway. But for trades of maybe a few hours, perhaps a few days, we do see people tend to lean towards the cash price for their particular type of oil. And then if we're looking at trades that last for maybe more than a few days, a few weeks, then that's where the futures markets. But it's completely up to you which of these products you use to trade. Let's jump back into the platform and take a look at some of these different contracts. So I've logged onto the CME website just to show you the various WTI in this example available on the NYMEX exchange. So these are the various futures contracts. So the front month is June. It's currently trading at $17. Then we go down July, August, and you can see the price is increasing as we get further out. And also for volumes, look at volume. So the June contract, 200,000 volume, July 53, August 19, then 12, 5. So you can see as we get further out, typically, but not always, the volumes will drop off, but most of the volume is concentrated in what's known as the front month. So typically the next expiring contract. And if we look on our contract, there's the July futures, Brent futures trading, and you can choose how big or how small you want to trade that contract. Let's talk about the different types of oil. So in financial markets when trading, there are two main types of oil. There's Brent crude, which you could think of as UK oil, and then we have West Texas Intermediate, the US version. There are some slight technical differences between these two types of oil. Brent, for example, has a higher sulfur content, and Brent is used for around about 2/3 of the world's pricing of oil when it comes to production. So I suppose if you were coming to the market afresh and you thought, well, which one should I trade? Looking at Brent arguably makes the most sense because it's used by more producers around the world. If you're in the US, you might have a slightly different view. WTI, West Texas Intermediate, is the US benchmark. Brent normally trades at a premium to West Texas Intermediate, the US version, because it is seen as a higher grade of oil. But usually, if we have a 10% move in oil over 3 months, we will see that reflected against both grades. But like I say, Brent tends to be the more widely traded. So when it comes to Brent versus WTI, so on our platform, we refer to WTI as crude oil. Let's just bring that up. So over the last few hours, it's gone from $17.20 as high as $19. So it's moved about $1.80. We'll take a look at the Brent spot price. So crude oil, WTI, trading around about $18.50. And there you can see Brent crude spot trading at the premium, trading around about $25. So higher than WTI spot, but a similar sort of move. It's gone from the lows of about 23.70, 23.80 this morning, up to 25.40. So you can see they do tend to move in tandem. Let's have a quick look at the different prices between the two. And to wrap things up, what drives the price of oil? We've said before, it's the global economy is one thing. So if the economy is strong, or it's expected to get stronger, the expectation is demand for oil will ramp up as factories do more goods get shipped around the world. So clearly, the global economy drives the demand side. Then we have the supply side as well. If we have an oversupply of oil, we saw in 2020 quite a significant oversupply in oil as the world economy slowed down due to the coronavirus. Then we did see this imbalance between supply and demand, and we saw the oil price fall really sharply. Political uncertainty plays its part as well. If we have political uncertainty and instability in oil-producing regions, that can affect the price. And finally, storage. This is something that again came into focus in 2020, where we had so much oversupply of oil, it had to go into storage. So we had, for the first time in history, a negative oil price for the May West Texas contract, trading down to about minus $37 a barrel. So producers effectively paying to have oil taken off their hands because storage was at such a premium and because demand had dropped so much. So all these interlinking factors drive the price of oil and guarantee that usually can be a pretty volatile market, which is clearly a key thing that makes it popular, Brent and WTI amongst traders. That's it for this quick update, looking at perhaps some of the different specifications of trading oil. So from me, David Jones and Capital.com, good luck with your trading.